As a tax-paying citizen in the US, you need to stay up to date with the latest tax change that just happened. In fact, it likely impacts more Americans than any recent tax change that we've had over the past 10 years. Now, we are constantly facing changes to federal regulations, and no changes have garnered as much attention and concern as this recent IRS rule adjustment. Now, from a distance, this change may have occurred small. However, it impacts millions of Americans, shaping up the way that we are taxed through online transactions. So if you've ever used platforms like PayPal, Cash App, or Venmo, this change is about to make waves in your financial world. So let's dive deep into the $600 IRS tax rule change and uncover why it has everyone talking about it, mostly from a negative position. So here is the rule that's changing the game. In 2023, the IRS introduced a rule that has many scratching their heads and others scrambling for their receipts. Previously, if you received $20,000 or more through a third-party payment processor, you'd be greeted with a tax document called a 1099. Now today, that threshold has plummeted to a mere $600. Yes, I said that right, guys, $600. So if you sell an old couch on Facebook Marketplace or you sell some concert tickets on StubHub, you might find the IRS is taking a keen interest in that transaction. But why does this matter more than you might initially realize? Well, for one, it's a potential tax trap. Imagine selling old clothes or furniture for like $600. Under the new rule, the IRS sees this as a potential taxable income. Without original receipts, you could be on the hook for tax on the full amount, even if you made no profit. Now, the IRS keeps changing these rules often, and if you're someone that's likely impacted by this change, which is pretty much everyone, then you might want to hit that like and subscribe button so that you aren't left behind on these tax implications. So now, here's the second reason this matters. The potential hidden costs. Come tax season, you might find yourself shelling out more during tax preparation. That 1099 K form isn't just a piece of paper. It's an added cost when using platforms like TurboTax and also just your tax advisor. These extra forms create extra work and tracking. With these changes, mistakes are bound to happen, and with new rules comes new complexities, and the potential for errors just increased, and many might find themselves paying more in taxes than they should have. Another reason this new regulation is interesting is it seems that the IRS is using its already limited resource on something very small. Is chasing after small transactions the best use of IRS resources? Some argue that there are major bigger fish to fry. But as with any rule, there are always workarounds. Now, some savvy individuals are turning to alternative payment methods like Zelle, which remains outside the purview of the 1099K form. Others might also revert to the age-old method of cash transactions to steer clear of the IRS's watchful eye. Now, the $600 IRS rule change is more than just a regulatory tweak. It's a testament to the rapid changing financial landscape. As digital transactions become the norm, it's crucial to stay informed and prepared. Now, while the intention behind the rule might be noble, its real-world implications could be vast and varied. As we navigate this new regulation, one thing is definitely clear. The world of online transactions will never be the same again. So before you make your next sale on a purchase online, remember the magic number. It's 600. Now stay informed, stay prepared, and always keep an eye on this ever-changing financial landscape here at Market Pulse. Subscribe and follow for more, and until next time, stay safe, Market Pulse members. Thanks.